Welcome back to the channel, guys. So today I wanted to dive straight into an insane strategy that I thought was very applicable and very powerful, and I wanted to share with you guys. So that strategy is essentially to turn your primary residence into an investment property. And so we're going to talk about the top reason why you would do that. And it is exactly the same reason why I personally don't own any primary homes, and yet I still own about $2 million worth of investment real estate. So if you're new to the channel, my name is Michael, and I am a full-time software engineer in the Bay Area. I invest in real estate part-time, and I show others why they should be investing in real estate if they want to grow their net worth. So let's dive into the topic for today. The first thing I want to share with you is, how do you actually turn a primary home into an investment property? Well, it turns out it's actually really easy. All you have to do is essentially move out of the property and then go find somewhere else to live. Now, obviously, again, you have three options here. Number one is you have to buy another primary home. Number two is you go rent, or number three, you go live with your parents. And I guess there is an option four, which is go buy a van and live in that. #vanlife. The very first step is to double check with your HOA if this is even possible. Now, the second step is to swap your homeowner's insurance with landlord's insurance. And the third step is to set up the property for the tenants. The fourth step is to take pictures, list your home. I personally use Zillow to list my home. And then the final step is to screen your tenants and have them fill out applications. And then you choose a tenant and sign a lease with them. And that's pretty much 90% of the work when it comes to doing a long-term rental. So it's relatively passive. Now, once you have a tenant, you can now claim on your tax return that you have an investment property, and you'll need to file an additional form with your tax return called a Schedule E. And to put it simply, a Schedule E is basically a form that essentially tallies up all of your income and all of the expenses for that rental property. Now, the main thing you have to understand when you do this conversion is that you are essentially starting a business. It's a rental property business, just like a rental bike business. And the main benefit you get comes from the fact that you are now a business owner, because in America, business owners can claim a lot of benefits that we're going to talk about in just a minute. So now that you've converted your primary home into an investment property, I want to share the most important benefit you get when you convert a primary home into a rental property, and that is tax benefits. If you're a high income earner, meaning you're in that 35 to 37% tax bracket, then tax benefits become a huge part of why you'd want to acquire investment properties or convert a primary residence into an investment property. So first, I want to explain to you why you need to understand real estate taxes, and then I'm going to show you my actual tax return so that you know that I know what I'm talking about, because I've used real estate in 2022 to pay about $80,000 less in federal income tax off my W-2 income. So if you want to learn more about that, stick around. And I'm doing the exact same thing this year in 2023. So consider subscribing, because I don't gatekeep any information on this channel. I only talk about concepts that are actually useful to people like me. And so if you want to follow along my personal investing journey, hopefully this helps you grow your net worth as it has for me. Now, if you follow my channel at all, you know that one of the most impactful concepts that has helped me grow my net worth is depreciation. So this is what we're going to be talking about. We talk about it in almost every video on this channel because it's the best tax benefit you only get when you buy an investment property and not when you own a primary home. So this is the biggest distinction between primary and investment homes. Remember that I said Schedule E is a form that sums up the income along with the expenses in your business. Well, depreciation just so happens to be one of the biggest, if not the biggest, expense in your business every year. Now that might seem like a bad thing, but it's actually an amazing thing, because depreciation is actually a special expense in your business. It's what we call a phantom expense. And the way that a regular expense works is that you have to first spend $300 to get a sink repaired, and then you can claim on your Schedule E that you had $300 worth of expenses. But in the case of a phantom expense, I never actually had to pay $300, and yet I'm able to claim a $300 expense. So how is this possible? So depreciation is a simple concept to understand. You know how if you buy a new car and you own it for a year, the car depreciates due to the wear and tear and for other things, and it's now worth less? Yeah, well, that's the same depreciation that we're talking about. But it also applies to your real estate investment business, because your business owns a property that is made out of components that depreciate just like a car. Now the point is that the components that make up your property are deteriorating year after year, and that deterioration is an expense in your business. Now, in order to calculate exactly how much you can claim as an expense in the name of depreciation, there's actually a formula. When you buy a rental property, you're actually buying two things. You're buying the land and then you're buying the building. But in this case, only the building is made up of components that actually deteriorate. Land doesn't have any components that depreciate, right? Land is going to be the exact same 40 years from now as it is today. And so we exclude the cost of the land from this calculation. So the formula is purchase price minus the land value is equal to the building value. Once you have the building value, you divide that number by 27.5 and you've got your annual depreciation expense that you can claim every single year for the next 27.5 years as long as you hold that property. Now, in order to find the land value of a property, you can go to the property tax bill, just Google it, which is public information, right? So just Google county property tax and then search up your property. There will be something called land and something called improvements. So that land, that's the land value. And every property is going to have a ratio between the land and the improvements, right? So the higher the improvement to land value ratio is, that indicates that more of your purchase price is going towards the value of the building rather than the land. Now remember, the more building value you have with your rental property, the more depreciation expense that you can claim on that rental property. Rental properties that are on the beach, for example, have very expensive land. So maybe 50% improvement to land value. So with that, you're not going to receive as large of a deduction for depreciation in your business because most of your purchase price was land, not the building. And again, land does not depreciate. So for example, if your rental property was $500,000 and you had a $100,000 land value, your improvement to land value would be 75%. You'd take your building value of $400,000, divide that by 27.5, and that's roughly $14,500 a year of depreciation expense that you can claim in your business every year for the next 27.5 years. Now, remember, in a business, you only have to pay taxes on the net income of the business. You can calculate your net income by taking your total income from your Schedule E and deducting all of your business expenses from that same Schedule E. The way that real estate investors don't pay income tax on their entirety of their rental income is by having the same amount of expenses in their business as they do rental income. So this is all theory so far. So let's take a more practical approach and let's take a look at my personal Schedule E so I can show you how to apply everything that you've just learned in real life. The first thing I want you to notice is that the total rents that I received is in the top row. This is for both my rental properties. So column A is my rental property number 1 and column B is property number 2. So the biggest deductions in my business are clearly mortgage interest, property taxes, and depreciation. Wait, but hold on. Why is my depreciation expense saying $213,000 and $183,000? That's a huge expense. And now we're at the big aha moment of this video because now I would like to introduce to you, for the very first time, bonus depreciation. Now put simply, bonus depreciation is depreciation on steroids, and I love it. With regular depreciation, you can claim an equal distribution of expenses every single year for the next 27.5 years. Remember, for a $500,000 property, we calculated that your depreciation expense would be about $14,500 every single year for the next 27.5 years, as long as you hold the property. But bonus depreciation allows you to front load that expense and claim a huge expense in the name of depreciation in that business for the first year that that property is placed into service. And then a reduced amount from years 2 to 27.5. So instead of taking like 14,000, 14,000, 14,000, 14,000, you could instead claim something like $100,000 and then 10,000, 10,000, 10,000, 10,000, and so on. That's what you're seeing in my depreciation expense column. I've elected to use bonus depreciation on both my properties, and so therefore, instead of taking an equal distribution of my depreciation, I'm taking a front-loaded $213,000 and $183,000 as an expense since this is the first year that I've placed these properties into service. So you might be wondering, how did I actually come to the numbers of $213,000 and $183,000? The answer to that question is a cost segregation study. Now, without going into much detail, a cost segregation study is a third-party service that you can buy in order to identify all of the components within your rental property that have a useful life of less than 20 years. So here's what a cost segregation study looks like. This is my actual cost segregation. It's just a PDF file that tells you here are the components with a useful life of 20 years or less, and here's how much these components are worth. Now, in the name of bonus depreciation, I can take the full value of all of those components and claim them as an expense in my business in year one. That's bonus depreciation. So if you add up that $94,000 and the $113,000, that's going to give you close to $213,000. So that's where I get this number from. The cost segregation itself can range anywhere from like $640, which is mine. Mine was called the DIY cost seg. But if you want someone to actually come to your house and actually look at your property, you're looking at, upwards of like $3,000 to $5,000. Now, side note, this was 2022. Bonus depreciation is slowly phasing out. In 2022, you were able to claim 100% of that cost segregation total. So that full $213,000. But in 2023, you can only claim 80% of that total number. In 2024, bonus depreciation is going to be reduced down to 60%, and then the year after, 40, 20, and then 0 until it phases out. But we might see bonus depreciation come back depending on who takes office next year and where the economy is at next year. The whole point with bonus depreciation, it's a way to stimulate the economy. So if the economy is bad, they might boost bonus depreciation up back to 100%. Now, to tie everything all up so that you understand why we do all of this, I want you to look at that last row here. This is my total amount of losses in my business, mostly created because of the huge depreciation deduction. And remember, that's just a phantom deduction. So if you look at my bank account, I guarantee you it's not showing a $389,000 loss. Those are phantom losses, right? It's a paper loss is what we call it. Now, that $389,000 loss is actually what we call a passive loss. And this is a core concept that you need to know if you want to understand real estate taxes. CPAs talk about passive losses all the time, right? And so since this video is going a little long already, I'm going to cut to the chase here. I am able to use those passive losses to reduce my W-2 and 1099 taxable income. So I was able to completely offset my $400K plus taxable income from my W-2 job and reduce it down using that $389,000 of losses from my business. And I reported to the IRS that my taxable income was not actually $400,000, but actually like $20,000. And so I only paid about $2,000 in federal income tax when I was supposed to owe over $80,000. Now, you can't just use passive losses against your active income. You need to qualify for one of two things. Either you go with the real estate professional status method, where you can go watch an in-depth video on that right here. Or if you can't qualify as a real estate professional, then the other option is going to be the short-term rental loophole. And you can go watch a video on the short-term rental loophole right here. Both of those methods allow you to use passive losses against your W-2 income without any income restriction, because both of those strategies allow you to transform those passive losses into non-passive losses. So a lot of people have this misconception that, oh, you make over $150,000 a year, you can't use those passive losses against your income. Well, with real estate professional status or the short-term rental loophole, you can, because essentially what you're doing is with either option, you're converting these passive losses into non-passive losses. And non-passive losses can be used to offset any form of non-passive income, which is your W-2 or 1099 job. So in summary, my strategy every year is effectively this. Number one, buy an investment property, or I guess you can convert your primary into an investment property. Now you have access to bonus depreciation. Number two, do a cost segregation study so that you can claim bonus depreciation on that property. Number three, you're gonna be able to generate a passive loss because of that bonus depreciation. And then number four, you're gonna use the real estate professional status or the short-term rental loophole to offset your active income using the losses that you generated from your business. This is how W-2 employees should be using real estate to help them pay less taxes. And so that's why I haven't bought a primary home yet, because primary homes don't give me passive losses because I can't claim bonus depreciation when it's a primary home. Okay. I know it's a lot to digest, but that's pretty much my entire strategy when it comes to real estate investing. You don't need to flip homes or be a wholesaler or start some real estate investment business or develop from the ground up. If you have high income, you can just conservatively buy one rental property every single year, generate a loss, and pay less taxes on your W-2 income. I guarantee you, if you can do that and not sell these properties, then your net worth is just gonna grow exponentially. Now, I realize buying a primary home is just as much of an emotional decision as a financial one, but does this mean I'll ever buy a primary home? Well, I think I probably will, but it'll be for emotional reasons, not for financial reasons, right? But if you're young and you want to grow your net worth, I personally feel that owning a primary home could be a huge financial trap depending on your situation. Anyways, I just wanted to share a potential option for you, something that, I had to get my wife on board with when we were looking to move in together. She wanted to buy a primary home, and I was telling her all these benefits of, owning rental properties instead. So hopefully you guys found this useful, and if you did, consider subscribing to the channel, and let me know if you have any comments down in the comments description. I answer pretty much all the comments in my channel. So if you want to connect with me, go ahead and use the link in the description to set up a one-on-one call with me. But anyways, that's it for the video, guys. Thank you guys for tuning in, and I'll see you guys in the next one. Peace out, guys.